Scott Groves here with another mortgage mystery. What is DTI, or what is referred to as debt to income ratio? The DTI, or debt to income ratio, is a very, very, very important qualification that's going to allow the lender to make a decision on how much money they can lend you. So, for example, and I'm going to use round numbers for my small brain, let's say you make $10,000 a month. The lender is going to have guidelines that says, based on the loan program, your DTI, or debt to income ratio, can be at 40% or 45% or 49.999%. Let's go with 40%. So the lender is going to evaluate your finances and they're going to say, okay, cool, you make $10,000 a month. That means 40% of your money can go towards your debt. In this case, simple calculation, $4,000 a month can go to your debt. Now, what does that $4,000 cover? That $4,000 has to cover your car payment if you have one, the minimum payment on your student loans if you have them, the minimum payment on your credit cards if you have them, and 100% of the cost of the house you're buying, including the mortgage, the property taxes, and the homeowner's insurance. So you can see how even if you're a high earner at $10,000 a month, if you've got a $600 car payment and a couple $100 on minimum credit card payments and a couple $100 on minimum student loan payments, that will eat into the DTI. In my hypothetical example, the $4,000, that will eat into your DTI and decrease your purchasing power that you can use to go towards the house, the mortgage, taxes, and insurance. Now, the good news is, if you've been fiscally responsible and you've paid off your debt or you've paid down your debt, and in this example, you have no car loan or student loan or credit cards, that whole $4,000 in this example can go towards financing your house and paying for the mortgage, the taxes, the insurance. In which case, of course, you would qualify for a larger mortgage and therefore a larger purchase. So the DTI, debt to income ratio, is the calculation the lender is going to use to evaluate all of your expenses, plus the future cost of the house on a monthly basis, compare it to your income, and then see if you qualify for the loan. This is also the number that lenders use to help you reverse engineer your purchasing power. So let's say you come to me and you say, hey, I really don't know what I can afford. I really don't know what I can buy, but here's all my paperwork. Tell me what I can buy. Again, we'll reverse engineer that. Let's say the program you qualify allows us to go up to a 50% DTI. Then it's a very simple calculation of saying, here's your income, here's your debts, car payments, student loans, credit cards, here's the remaining money that you have to spend on a house. Hey, Mr. and Mrs. Klein, it looks like you can buy up to a $300,000 house or up to a $700,000 house, because our team knows how to reverse engineer those numbers. So if you're just starting to kick the tires, you really don't know how much you make in comparison to how much you can spend, and you don't really know how to do that calculation, I wouldn't expect you to know, then give us a call, get on our calendar, leave a comment below. We'll get with you within 24 hours so we can start gathering the paperwork, have a conversation about your income and your debt, make that comparison, and help you zero in on what kind of house you can afford at what price. Scott Groves, Mortgage Mysteries. Do me a favor, click the like button, subscribe to the channel, and if you need to get a mortgage anywhere in the country, give us a call. If we don't happen to be licensed in the state where you're looking to buy or refinance a house, we can put you in touch with a great loan officer in your area who can walk you through all these mathematical calculations and help you get into a great house at a great rate.